The S&P 500 just closed at a record high. Check your 401k, then check your grocery bill. On Wednesday, May 8th, the S&P 500 hit 6,100. The Nasdaq hit 19,000. Both are all-time highs. This is the sixth straight week of gains. Chip stocks led the rally. Nvidia hit another record. Micron had its best week in 2 decades. Meanwhile, consumer confidence just crashed to its lowest level since 1952. That is not a typo. That is 74 years of data. The last time Americans felt this pessimistic, Harry Truman was president. So, what is going on? Why are markets celebrating while Main Street is panicking? Let me walk you through the disconnect. First, let me explain what is driving the stock market. The rally is narrow. It is being led by a handful of tech giants. Nvidia, Microsoft, Apple, Amazon, Meta. These 5 companies account for most of the gains in the S&P 500 this year. The other 495 stocks, they are basically flat. Why are these stocks going up? 2 reasons: artificial intelligence and interest rates. AI is the narrative. Nvidia reported earnings last week that blew past expectations. Revenue up 260% year over year. The company is now worth more than JP Morgan, Bank of America, and Wells Fargo combined. Investors are betting that AI will transform every industry. Maybe it will, maybe it will not. But right now, the bet is paying off. Interest rates are the other piece. The Federal Reserve has been signaling that rate cuts are coming. Maybe not next month. Maybe not this summer. But eventually, when rates fall, growth stocks become more valuable. That is why tech is rallying. Now let me talk about what is happening on Main Street. Consumer confidence is measured by the Conference Board. They survey 5,000 households every month. They ask about jobs, income, and business conditions. In April, the index fell to 67. That is the lowest reading since 1952. Why are people so pessimistic? 3 things. First, gas prices. The Iran conflict has pushed oil above $100 a barrel. Gas is now above $4.50 a gallon nationally. In California, it is over $6. That is a direct hit to every family's budget. Second, grocery prices. Food inflation has slowed, but prices have not come down. A carton of eggs still costs double what it did in 2020. Ground beef is up 40% since the pandemic. Your grocery bill is not going down. It is just not going up as fast. Third, housing. Mortgage rates are still above 7%. Home prices are still near record highs. If you rent, your landlord probably raised your rent this year. If you own, your property taxes and insurance probably went up. Here is the key insight. The stock market is forward-looking. It prices in what investors think will happen 6 to 12 months from now. Consumer confidence is backward-looking. It reflects what people are experiencing right now. Investors see rate cuts coming. They see AI transforming industries. They see corporate earnings holding up. They are betting on the future. Consumers see gas prices. They see grocery bills. They see their credit card balances growing. They are living in the present. Both can be right. That is the uncomfortable truth. The market can keep going up while regular people feel squeezed. In fact, that is exactly what happened in 2023 and 2024. The S&P 500 gained 50% over those 2 years. Real wages barely moved. Inflation ate most of the gains. So what does this mean for you? If you have money in the market, enjoy the ride. Your 401k is up. Your IRA is up. That is real wealth. Do not let anyone tell you otherwise, but do not confuse stock market gains with economic health. The market is not the economy. The market is a bet on corporate profits. Corporate profits can go up while wages stay flat. They can go up while layoffs happen. They can go up while consumer confidence crashes. If you are not in the market, this rally does nothing for you. You're watching other people get richer while your bills get bigger. That is the reality for about half of American households. They do not own stocks. They do not have 401k plans. They are living paycheck to paycheck. What should you do? 3 things. First, if you have a 401k or IRA, keep contributing. Do not try to time the market. Do not sell because you think it is too high. The market can stay irrational longer than you can stay solvent. Just keep buying. Second, pay down high-interest debt. Credit card rates are above 20%. That is guaranteed return. No stock can beat that. Third, build your emergency fund. The job market is still strong, but consumer confidence is a leading indicator. When people stop spending, companies stop hiring. That takes about 6 to 12 months to show up in the data. We are in month 1 of the confidence crash. The clock is ticking. Here is the bottom line. The stock market is at an all-time high. Consumer confidence is at a 74-year low. Both are real. Both are happening at the same time. The market is betting on the future. Consumers are living in the present. The gap between the two is where the risk lives. Watch your own numbers. Watch your own budget. And do not assume that what is good for the S&P 500 is good for you. If this helped you understand the disconnect, hit subscribe. I will be back with the next data point.